Okay, so Daniel, on this point, I've been looking at arguments from both sides. Okay, people for it, people against it. Some people say that companies, they just use the extra earnings that they get. So let's speak on either raising or reducing the corporate tax rate to begin with. Just say in the USA, some people argue that companies, they just use the extra earnings to just buy back their stocks. They just benefit the shareholders and the value of the business. Is this the case?
Well, the first thing that we need to understand is that companies don't buy back shares because they're evil. They buy back share as an option that comes after their investments, the hiring, and all of the different activities that they undertake. What one cannot just go out and say to companies is that they need to spend more if the opportunities are not there or if competition is not attractive enough. So what we need to understand is that the decision of capital allocation is given to managers for a reason, which is that they know that capital allocation has to be sent to the areas in which it's most beneficial. So first, investment, second, hiring and different standard activities, and obviously if there's some value left, that what they will do is buy back shares if they're interested. But this idea that companies simply buy back shares because they're greedy is ridiculous. There is absolutely no evidence that companies are under investing or underspending. And the other point is that the idea that it would be better for the government to use those funds is also ludicrous, because the concept of raising taxes affects that all of the companies, even those that don't buy back shares. Because when we talk about share buybacks, we're basically talking about a very small proportion of the corporate fabric of the United States, for example. And in the rest of the world, buybacks are very, very limited. So the idea that it's either high taxes or buybacks is flawed to start with.
So you think from a lot of the arguments for reducing the corporate tax rate is to stimulate the economy. You feel that because there's only a small subset of companies who can even buy back their shares, we still get a stimulation effect in the economy by reducing the tax rate.
The first thing that we need to understand is that the corporate tax rate comes after a very large number of other taxes. Companies pay business activity taxes, they pay building taxes, they pay revenue taxes, they pay local and regional taxes. They are paying taxes all throughout their earnings before we even talk about the corporate income tax. So it's another flawed argument here to talk about low corporate taxes before even concluding that we have to look at the entire tax wedge. And the entire tax wedge shows us that corporate taxes are enormous in the United States. We look at, for example, the pay in taxes report that Price Waterhouse publishes. We can see that the tax wedge is actually double what many are talking about right now as a minimum level of corporate income tax. The other point of corporate income tax is to understand that in itself is it is a negative to investment and to growth, not just because of large companies, but because of the entirety of the business fabric. Corporate income tax cannot be extremely high because it deters businesses from continuing to function normally. And the other point is obviously that there are some level of tax deductions that companies utilize. Absolutely, they are. But we cannot forget, again, that corporate income tax comes after a large number of other taxes that make the tax wedge on businesses way too large for a modern society, the total tax wedge. The other important factor that we need to understand is that raising the corporate income tax disproportionately impacts negatively the collection of all of the other taxes that businesses pay. By focusing only on the corporate income tax, as we are seeing right now in the political debate, they are missing the fact that impacting that will have a negative impact on other taxes that have a much higher revenue power, like, for example, the salary taxes and the revenue taxes, business taxes, no, that come way before the net income of a company.
So how does that happen? By disincentivizing investment, by taking the money from the earnings of the company, giving it to the government, it means it can't be reinvested to generate these additional taxes. Am I correct?
Absolutely, not just that, but also it works as a disincentive to create new companies. Let's remember that the and profitable ones. So there's almost a perverse incentive to have loss-making or not profitable companies, because the tax wedge on all of the activities is so large that ends up eating the possibility of creating new companies and companies that actually work and have profits, which is what makes them sustainable. The other point about this ludicrous idea of a global corporate tax rate is that it comes from the view, obviously, of people that have never started a business. It is the perfect tool to destroy so many countries that whose most important tool to attract investment and attract capital is precisely to have a competitive taxation system, isn't it? So it's obviously very allegedly easy to think from the perspective of a bureaucrat in Washington that everybody in the world, no matter what country, should pay whatever amount of corporate income tax. What they're not talking about is the negative effect, spillover effect created on investments abroad, on and also revenue collection abroad. Ultimately, it all comes down to one very important factor. Taxation is not based on what the bureaucrats should or do think is what they need to collect. Taxation needs to be based on the principles of logic, of business keeping the businesses alive, and also of the capacity of companies to pay those taxes. If what we do is simply put a minimum corporate tax rate, what we're doing at the end of the day is also putting a maximum profit generation. And that maximum profit generation is going to end up eating a lot of the revenues created with other taxes. I come back to the point. The ludicrous and completely false message that businesses and corporations in America are not paying taxes comes from ignoring all the list of taxes that they pay before we even talk of a net income.
You've written a book, Freedom versus Equality. If we were to see this equality of tax, corporate tax across the globe, let's say, hypothetically, what type of freedoms are we talking about that we're exchanging for that or giving up for that?
Well, the first one obviously is the sovereignty of so many countries in terms of attracting capital and attracting investment. Taxation is a tool, is what a fiscal policy is one of the main tools that a government has to promote prosperity and generate growth and jobs in a country. The second one is obviously that these bureaucrats are talking about a minimum corporate income tax rate, but they're not talking about a maximum government size, which is what they should actually be starting to talk about, because little by little, government spending takes more and more of the GDP of a country each year, and they constantly blame the problems of the economy on the productive economy, that saying that it doesn't pay enough taxes, instead of talking about the growing size of the unproductive and administrative bureaucratic part of the economy. So I think that obviously it is just another stepping stone in trying to extract a lot more wealth from the productive economy to give it to the unproductive part of the economy.
So we see the idea as being, as this catalyst here in America, we see Germany seem to be on board. Are we going to see other countries, or other countries like Ireland, like Singapore, these lower corporate tax rate areas, are they going to be able to resist these developments and these pushes towards this global tax minimum?
But obviously they have to. I mean, for Ireland, for Singapore, for so many countries globally, having a competitive tax rate is a key tool to have a prosper country with good job creation and with good investment. So the idea that large nations that have already a very aggressive and large business fabric can impose to others an uncompetitive taxation is ultimately a measure of protectionism from the large economies. Think about it. Obviously, if you have 500 of the largest companies in the world in a country, your ability to destroy a little bit of the fabric of the economy, of the business fabric, or a large proportion of the fabric of the economy does not worry you so much if you're a bureaucrat. However, if you're a small, competitive, and growing country, losing part of the business fabric of the economy is devastating. So think about this. It's ultimately an extractive and at the same time protectionist measure, because what countries, big economies have is that the very large corporations that they have in the country are actually very supported by government subsidies, by different elements that they can deduct from their tax wedge. That's not something that competitive and smaller countries have. Therefore, I come back to the point, it is a protectionist and extractive measure. Thank you for watching this video. Please subscribe to my channel, like my videos, leave your comments below, and keep defending freedom. Thank you very much.